Hello to the few and special who watch this. So this video is going to be about Douglas Dynamics, ticker symbol PLOW. This is a company I've invested in back in 2021, so almost 3 years ago, I guess 2.5 years ago. And I probably made some mistakes investing in it at the time for the price I did. Yeah, my reasoning at the time was I was after childbirth and pretty sleep deprived, pretty time deprived, and I was sitting on a lot of cash at the moment, and I knew that inflation was coming because of all of the money printing that was going on, so I was really under pressure to put my money to work somewhere. And I looked at PLOW, I call it PLOW, Douglas, at the time, and it seemed to me like a stable, boring company, like with the dividend to invest in. I thought I still think it at the time it was fairly valued. So I did commit some a medium position in it. But I think my biggest mistake at the time was that I did decide to invest at fair value, and I shouldn't have done that. I will from now on try to either invest at big growth at a fair price, which would be small positions, or if it is a boring, stable dividend company like Douglas Dynamics, it should be undervalued and there should be a margin of safety, and that's what I'm feeling right now, that it is my cost basis is $39, and right now I'm really down on it, which is okay. I'm sleeping well with it, and we'll see that I might add more now that it's down, but I probably should have waited for a better buying price or just skip it at all. But never mind, not the biggest mistake, but I just wanted to share it. So let's dive in a little bit to what this company is and what's going on right now and why the stock price is down, and what I think about the future, and should I sell, should I hold, or should I maybe buy more. So just let me put myself right here. So Douglas Dynamics. This is a company that does certain attachments and solutions, different products and equipment for handling of ice and snow. So for the removal of snow, they have those PLOW attachments and trucks, and they have also spreaders of sand and salt to handle ice and snow, I guess. So they have two separate segments which they report separately, and the work truck attachments and the work truck solutions, where they have different brands. We'll talk about in a minute about acquisitions, how they got those brands, but under attachments, they have those three brands where they create attachments that are attached to like smaller vehicles, like we see here, and under solutions they buy OEMs like trucks from I think mainly Ford and Chevrolet, and they upfit them with different equipment. They're telling a little bit a story where they have different equipments for different purposes, but I think like 99.9% of the revenue comes from solutions that are related to removal of ice and snow, which again could be different, maybe different configurations or different solutions for different cases, but it is still removal of ice and snow. So just a little bit about the differences in characteristics between those two segments. In the attachment segment, their customers are mostly commercial companies that do services of ice removal on demand for sometimes municipalities, but I think mostly residential and commercial customers of them. And so again, the customers are more commercial. They say they have about 500,000 of snowplows in service out there. They work with dealerships. So they say they have over 3,000 points of sale. Dealerships. And this segment is very highly dependent on the snowfall each season. We'll talk extensively about that soon. Whereas the solution segment, those are the big trucks, and so mostly their customers are municipalities and the government customers like the Department of Transportation. They have a lot of customers. Again, those are mostly municipalities, and they use the chassis, which we'll again talk about extensively soon. So they buy those big trucks, which are the chassis, and they upfit them. And this segment, they say, is less dependent on snow. I can't say I understand totally why. I mean, still, those are products that remove snow, and I think most of the business of Douglas comes from the renewals. And they say that, at least they said that in the attachment segments more, but it's probably true for the solution segment also, that the average lifetime of an attachment, or I think, I don't know, maybe just an attachment, is like 7 to 9 years, assuming there is an average snowfall, which when there is snowfall, the equipment is being used and it's being worn out, and then after a certain time it needs to be replaced. So I think most of their business are those existing and loyal customers that once in a few years need to replace their equipment. This is true for solutions also, but somehow they say, and we can see that in the results, that it's still less dependent on snowfall. I mean, I'm sure it is, but it's more dependent on the macroeconomics, which again, I can't say I understand fully why, but I guess I'm thinking, I mean, an educated guess is that when it's dependent on the budgets of municipalities and Department of Transportation, and I guess when the macro is good, they have bigger budgets, and then when there is a slowdown, the budgets are tightening, and there is less expenditure even on snow removal, I guess. I'm not sure. So we can see the results of the different solution, the two segments in the past 3 years. So the picture here is not totally, I mean, it's accurate, of course, but it doesn't really reflect the two segments really well. I just pasted it here, but there have been different problems, different headwinds, and different maybe even tailwinds, but mostly headwinds with those two segments. So it's not really reflective of the organic or natural growth of the two segments. I mean, since COVID, they had so many issues. So we'll talk about that in a second. But just to show that the attachment segment is the bigger one than the solutions, but not by far. This is the main point. But I wouldn't conclude about the growth of the segments from this slide. So yeah, a little bit about the history of the company. We can see it goes way back. It's really an experienced company already. I think I saw in the annual report that it was incorporated in 2004, so I guess that's when they were bought out. And what I wanted also to show with this is their strategy of acquisitions, which they do hold, where they, once in a while, they acquire another company, which I don't know, those I guess those are already really incorporated into the company, into the other brands. But Henderson and Dejana are their biggest acquisitions, where they're really like a brand of their own, and now they're a segment of their own. Those are the solutions segment. And the company does say they're planning to continue like strategically when they have a good opportunity to buy out other companies. What they usually do, we'll talk about that in a second, but they usually finance that with debt, and they take a few years to reduce the debt. which is fine as long as it's moderate and not too aggressive, of course. So this is just to show just how much Snowfall affects the performance of the company. We can see that even in the years with the lowest snowfall, they still remain adjusted EBITDA positive. I haven't looked at the net income margin in 2012. It might have been negative, but overall we see that the company exists many years already, and it's seen its share of low snowfall seasons. And yeah, just to give a general impression, we will talk soon about how this year and last year are unprecedented even for them, and we'll get to that. So how exactly do they go? One thing I did want to show here, which we'll see in another slide soon, but that they do manage to grow pretty well. I mean, this is a nice growth for such a boring business. And how did we do that? They have some organic growth, where they, I guess, capture some more market share, and they get to new municipalities, and they do have more new products that they introduce. But I'm not sure how much those products are replacing the existing ones and really give the same solution, or they're addressing like a new market, a new addressable market. I'm not sure about that. I'm guessing they're more like to the same market. So I'm not sure how much it should expand their revenue really, but I'm not sure. I don't know. But mainly the way they grew is via the acquisitions we talked about, where again they buy a company once in a few years, they integrate it, they reduce the debt, and then they're ready to buy again. They are saying they are on the lookout right now. I don't think they're in a financial position to, I think they know that right now. Maybe in a few years they will be able to acquire a new company and integrate it to the company. They did have successful integrations. I mean, I'm always scared of M&As, but those it seems very prudent when they don't make some crazy acquisitions, and they don't take crazy debt for them, and they do it really prudently and carefully. I hope they will continue to do it that way. I'm not a big fan of roll-up companies, but I don't think it's a roll-up. I mean, they have their own core business, and they add to it a little bit from here and there. Maybe not a little bit, but it's not like a really roll-up company, which I wouldn't touch if it was. And they do have price increases, especially in recent years, where we all experienced high inflation in every aspect of our lives, but they did too in labor, of course, in the price of labor, and they did. We'll talk soon about inflation more in detail, but they had everything: the chassis and the cost of steel, and so yeah, so they did increase prices a lot during the last years, which again we'll talk extensively in a minute. But I'm not sure that it's one of their growth strategies. I mean, there's also have been some unique, unusual years. So just to mention a few more things, according to the company, which I'm not sure how much that contributes or will contribute from now on to the revenues, but they do have a strategy when they try to introduce more products which are not snow related, or non-truck equipment, which right now it's not material. I personally don't think it's gonna be material in the years to come. Not something that would affect our price, our valuation models or our growth expectations for the company. The company saying the snow belt, which is the snowy area of the northeast of the United States, is expanding south. I don't know. I tried really briefly to search about it. I haven't found anything about it. I'm not saying it's false, but I don't know how material that is and how much it's really happening. Again, I haven't found anything on it, but it's super niche. I'm not sure how many. I don't know. Articles that are out there about the expanding snow belt, so I don't know. It's again super niche. Maybe what I'm sure is that we haven't heard from them any specific news where they have like this new whole customer base in the southern of the traditional snow belt. So again, I'm not gonna count on it, or just I'm gonna disregard it, honestly. And they also have been mentioning a few times that they're trying to expand globally. I don't even know where. Again, I'm not going to take that into account. So yeah, so this is the history of the revenue growth. We can see that up until COVID, it grew really nicely, thanks to all the strategies we just talked about. Maybe I'm not sure about the price increases, but except that. And then COVID happened, and they had those shutdowns, and of course everything was distorted in 2020. And since 2020, they had a lot of headwinds, which they are still facing right now. We will talk about them in a minute with much detail. But we see that the company hasn't really gotten back to for sure to its growth, but it even has barely gotten back to the revenue level it had before. But right now, maybe it is a little bit premature to talk about it right now. But analysts are expecting some improvement already from this year on. We will talk soon about that, why, and how we should think about it. But long term, I think the company is growing. Again, it's having some headwinds right now, which should get better in the next years. But I think this could reflect the future growth of the company. We'll talk about that in a minute. But, okay, so the revenue is growing really nicely, but the earnings of the company is what's really suffering. And this is due to the declining gross margins for almost a decade now. And even if we exclude this 2015 gross margin as an anomaly, we can say that since 2016, the gross margin has been declining and declining and declining to the point where even if revenues do grow really nicely, even with the COVID bump, we see that the earnings of the company have been stagnant for a decade and a half now, and this is pretty crazy, honestly, to see. Again, a nice growth company can't grow its earnings. We'll see. Okay, let's talk about why. But of course, this is the big concern with Douglas Dynamics, and this is the one of the main reasons. I mean, maybe the main reason why the stock price is suffering also. So let's talk a little bit about why. So again, the gross margin is declining for what's going on. The gross margin is declining for many years now, and they always have a reason for it. So it was before COVID, it was already declining, and I wasn't able, I honestly could have maybe researched a little bit more, but I wasn't able to understand exactly why. Maybe it is important and I should have researched more. But I looked at the annual reports, and all the annual reports from 2016, 15 and 17 and 18, that's what they say. That the decline in the gross margin was due to the decline in gross margin in the Walk Track Solutions segment. So I'm not sure what that means and why there was a decline. I think the biggest worry when gross margins are declining are first the business model, if something changes about the business model. And of course it could be here, but I can't even think about what could that be. I mean, if they had price increases in their costs, that would usually mean they would increase their costs for the customers like they're doing right now. And we'll talk about in a minute how they are increasing their prices right now. So I think the biggest concern where gross margins are declining are price competitions, that the company doesn't have enough pricing power and it can't roll their expenses to the customer. And I don't think that's the case with Douglas because of recent years, but I'm not sure. Maybe everybody is raising prices because of inflation, so they're raising prices also, but they still can't raise them enough to offset their increase in expenses. So it is super concerning. I mean, it is the biggest risk with the company, the biggest headwind, the biggest problem. So then COVID hit, and they had all these reasons related to COVID when they had shutdowns, of course, increased expenses and not enough revenues and not enough production. And then after COVID was kind of looking like it's behind us, there came the inflation, which really affected Douglas Dynamics because they had an increase in costs in labor, in materials like steel, in the chassis that they're purchasing, and it took them some time to roll that to the customer. And it seems like, I think the messaging right now from the company that they already did, but it just took some time because they have these multi-year contracts with like municipalities in the solution segment. So they can't increase in the middle of the agreement the price. So they needed to wait for that to be over to renew some agreements. And then they could increase prices. Again, I feel like that's only part of the story because there is another segment there, which is a bigger one, which is the attachments. And yeah, we don't really know. I mean, we can always research more, but I think I've researched enough. So that's the info I was able to come up with. So right now, what is still affecting big time their margins are still the inflation, which they are still struggling with, but it's getting better. They already said in the few last quarters that this seems really much better right now, and they are able to increase prices, and the labor market has becoming better. So the biggest things that are affecting all their performance right now is weather, which we'll talk about soon, and the chassis supply issues. So we'll talk about that in a second. I just want to mention that the operating margins are steady. I mean, this is all the gross margins, and their expenses like the SG&A and all the other expenses seem pretty steady. They have increased interest expense, which we'll again talk about soon. But it's only the gross margin, which is not. I'm not here to belittle that. It's a big deal. But the operating margins are steady. And I already mentioned the price competition. And this management is expecting long term to get to a mid to high. They say the EBITDA margin, but I think that might have been a mistake and they made gross margins, but I'm not sure. I mean, that's what's something the CEO echoed what the CFO said, but I don't know, mid to high EBITDA margins seems a little bit stretch for me. I think that's more like a gross margin. So if they get to mid to high 20s gross margin, I think that's what they're aiming for. That's what they believe they would definitely be able to do in a normalized environment without the two big headwinds, which are the chassis supply issues and the weather conditions in the last 2 years. And that's where they think they're normalized earnings, gross earnings are supposed to be. It seems realistic to me. Again, following the company a few years now, I think they can get there again in a normalized environment. So let's talk about those two big headwinds, the chassis supply and the weather conditions. So since the COVID, since 2020, it seems that there is an industry-wide, even multiple industries-wide chassis supply chain issues where there's just not enough chassis to go around in different industries, different sectors. I just tried a little bit to research about it because it's a rabbit hole I didn't want to get into, but I saw that it was from delivery trucks, from ports, to chassis for containers, to even ambulances and fire trucks. So everybody's suffering for that. I also own Malibu boats, and they use chassis also, and they're in a shortage of chassis. So the situation got really bad where they were really long lead times for ordering chassis and waiting for them, and the market was really unpredictable, and the company never knew when and how much chassis will it be able to get. At first it seemed like it's probably gonna get normalized in a year or two, but it's been like 3-4 years already, and it's maybe less, but like 3 years, and it's not improving in the pace that everybody expected it to, and it seems like it's here to stay for a few years at least more. There is a slight improvement. I guess just everybody is kind of getting used to work with it, but there is not really a ramp up in production, which I personally don't understand why, but again, it's a rabbit hole I didn't want to get into. It's probably gonna at some point just go from, which I wanted to also address, but from like an over demand to an oversupply that will create some kind of a shock that also scares me. But again, that's more Ford's and Chevrolet's problem. But yeah, right now there is still a serious lack of chassis in the market, and the company is really suffering from it. And it's not clear when it's going to get better. Right now, they're predicting that there's not going to be any improvement in 2024, not something material, maybe slight. So that's what the company is working with right now. That's in the solutions segment, which we use truck chassis. So the company believes, and we all believe, I also believe, that if there were enough chassis, of course, their earnings power is much higher, but they're not able to meet all the demand, and they also have a huge backlog, which they are not able to meet right now, and it's going a year or two ahead. So yeah, that's what they have to work with right now. They're trying after a few years, everybody kind of accustomed to this environment, and that's what they're working with, and they're trying to get all those creative solutions. They can like stick some band-aids around it, but of course the core business is suffering from it. Again, that's what it is. It's gonna stay for a few years now. I am worried what's gonna happen a little bit, just because I got sunburned by SolarEdge when it went from over demand to oversupply, which again here Douglas is just a customer of the industry. It's not the producer, but I'm still worried that right now it has this big backlog because they're not able to meet all the demand of their solution segment and of the upfitted trucks. And if suddenly there is a next year, or next year probably not, but in 3 years, I don't know, Ford or Chevrolet, they get themselves together, and they will be able to ramp up their production, or maybe there will be more chassis imported from somewhere, or maybe, I don't know, it will resolve itself somehow in the end. And what would happen to Douglas when they suddenly will be able to get all the chassis they need? I mean, it could be it would for sure be some kind of a shock, even for a secondary company for the problem like Douglas. So it could, I don't know, if I'm trying to imagine it, and it for sure will not look like I imagine it. It for sure will surprise us somehow, but they will suddenly get a lot of chassis, suddenly will be able to provide a lot of the product for the customers that are waiting for it, and then they're gonna have a really boom in the revenues, and then what would be the normalized revenues for solutions after that? They're gonna be probably bust. We need to be really careful of that. I think if I see suddenly a big bump in the like a bump up in the solutions, in the revenue of the solution segment, I'm gonna sell, because that scares me, and I got really burned with SolarEdge with that. So just like a small comment about that. So that's about the chassis. Now about the weather conditions. So there were 2 years now where there was almost no snow in the snow belt, which are the main customers of Douglas, in the major cities like Boston. there wasn't snow almost at all this year, and I think last year too. And the company says that they've seen their fair share of low snowfall seasons in the past, because it's always volatile. But this is unprecedented. This is the first time they've seen so little snow in 2 years, when it's not after the last year they thought it's gonna normalize this year, somehow correct itself, but it didn't. And we can think whatever we think about that, and of course climate change, and I think I will talk about that, about my thoughts in the conclusions. But yeah, that's what they're dealing with right now, and of course it has affected tremendously their revenue, especially in the attachment segment, and they are hoping for next year for a normalization. I mean, would there be a third year without snow? Take your guess. I think mostly, again, we'll talk about that in the conclusions, but I think whether you invest in PLOW, I call it PLOW, Douglas or not, is a lot if you think that there's going to be snow still in the future or not. So again, I'll talk about that in the conclusions, more about my thoughts. Happened during those 2 years is that they got really low on cash flow and low on cash reserves. And right now, I don't know how much the situation is worrisome, and this is me. I don't still know how to gauge those situations, but they did increase, of course, they used more of their credit facility, and they increased their revolving credit facility also. And so right now they're adding a little bit to the debt every time, not so little, but okay, little, to the debt every time, because they still they just don't have enough cash right now going around. They have really low cash. This is also after 2 years of low snow. And they're also saying it has been due to several other but it's all related to the low snow situation. So what happened is the inventories got larger, and the inventories with the dealers got more inflated, so it's gonna take time for them to destock. Not crazy, but it's gonna take time for the dealers to destock, for the inventories of Douglas to go lower. But what they are saying is that the low cash flow this year was mainly because of negatively impacted working capital, which relates to the timing of supplier payments. I'm not sure what that means. I mean, I admit I haven't researched that deep enough, but it seems like both their accounts payable and their accounts receivable are usual, like end of December levels, like it used to be in prior years also. So I don't see any anomaly here where their accounts payable is lower because they already pay them, and their accounts receivable are high because they still haven't received, so the cash flow is low. And if it was the case, then I would expect higher cash flow next year. I'm not sure about that, I'll admit. Again, I could have maybe researched that a little bit more. But what I wanted to say is that right now they have this elevated debt because they didn't have enough cash in the last 2 years, and they increased their debt. Plus, they sit still on low cash, like 20 million in cash. And I'm not sure what the cash flow expectations are for this year. They already increased their revolving credit facility, and they increased the range of leverage which they have approved for themselves because they exceeded that. So right now they have related to their EBITDA, which is depressed, they have a higher leverage. So it's a little bit meh, but I think I never know how to think about it with companies like Douglas, because it is a stable company. They will be able to get financed. And again, assuming that in the next 2 years, they will have average snowfall, I mean, just normal snowfall, and that the chassis supply would begin to normalize somewhere in the next few years. I mean, they will do well. They will be able to get the finance they need. They're not going to go under because of that. But it is uncomfortable to look at. We'll talk about the dividend soon. I personally think that they could have halted the dividend right now just to make that spare cash to leave it in the company. But I understand that's a sacrilege for dividend investors. I'm not a dividend-oriented investor, so I think it would be best for just the management of the cash of the company. But again, I'm a little bit maybe jumping ahead, but they're saying that the dividend is super top priority for them. Again, dividend companies always say that, and then the next quarter they can cut it, which I'm all for. I have no problem with that. But for them right now, they're saying the dividend is top priority, so they will take on more debt, they will increase their leverage, they will increase their credit facility to keep the dividend. So, okay, I guess a company with volatile revenues that are dependent on external factors like Snowfall, like Douglas, can't really cut its dividend every time there is a low snowfall. So I guess it makes sense, but those are kind of extreme circumstances right now where it's not just a low snowfall season. It's like a little bit, I don't want to say the perfect storm because the situation is not that bad, but there's this combination of factors that are really creating a big headwind, and maybe it would be best to halt the dividend. But okay, that's just me. I get it. That's okay. So this is I said that already. So this is the capital allocation. We can see that their return on invested capital has been around 10% for. Again, until COVID. I like that. I think it's a good return on invested capital for a company like that with, I don't want to say capital intensive, but it's not like super light also. So it is a nice, and around 10% is okay. So I talked about the debt, which is pretty elevated right now. Again, not the end of the world. I don't know. They're comparing their debt to the EBITDA, but where you look at net income margin and cash flows during the past few years, it is super high debt. I mean, where they're making only 20-30 million a year, but I mean, it's not their normalized revenues, earnings also. So I'm ranting. Okay, so what I wanted to show here, the slide I skipped, was that there is expected to be improvement in the earnings, which have been stagnant for a long time now in the next year. So here we can see the history of the earnings, and this is non-GAAP, but still they do expect finally an improvement in earnings, which and the company was committed, very committed. They set a few years ago, they set a target of $3 of EPS by 2025. And they still pushed super hard until 2 quarters ago that they're gonna get there, and they're absolutely confident in that. And of course now it's not turning out, and they're saying they will get there. The company believes that their earnings power is $3 of EPS. Again, non-GAAP, but it's gonna take longer now because of the headwinds, because of what has happened with the snow during those 2 years, and the chassis supply, which aren't getting better for years now, and it's kind of surprising everyone, admittedly, really. So again, they will get there. They do believe they have the potential for that. And right now there are some external factors that are preventing them from getting there in 2025. It's going to take probably a year or 2 or 3 more. So we talked about that. So about the dividend, again, I'm not a very dividend-oriented investor, although I do kind of need the income, but I might do a separate video about that. But this is the dividend, just to talk about it. Right now it's 4.7% yield. They have been growing their dividend for 13 years. They have announced, I think in the last dividend, also a little small addition just to show the growth and their commitment to it. The growth is not stellar, but okay. We can see that the cash flow is really low this year, and they're gonna have to use that credit facility, debt, to finance it. But hopefully, it would get better in the next year or the year after that. I already talked about their commitment to the dividend. So we're getting closer to valuation. This is the growth numbers of the company, and I had this screenshot from where I first analyzed the company in 2021, and we could see how the company was growing its different metrics until 2021, and then the world changed, and this is how it looks right now. So why I use this is mainly because Buffett once said that the growth, the historic long-term growth of the book value usually would suggest the long-term potential growth of the company. I'm not sure I completely understand why, but Buffett said. So I'm surprised in discovering that that's often really is the case, which so we can see here it's even accurate. It's not always that. It's not usually that accurate. I think it's a coincidence, but still. So I do look at it. So we know the company grew about really like 13% a year, again due to acquisitions, which it's not always going to play out the way it did before. It could play out better, but it could also play out worse. If I had to bet, I would bet on the worse because of the risks with M&A. And of course it had some organic growth, which I would expect it to slow down. I wouldn't project that going forward, plus all the headwinds. And of course, revenue was growing, but earnings were not. So if we look at the long-term growth of the EPS, so of course their earnings were not growing. This is, of course, not accurate. I don't know where that comes from, but we saw that the earnings were not growing as much as the revenue, and that's why I'm going to assume, again, we're getting to the valuation, a growth of, I think, 6%, where I think the company also said that they're expecting one of the segments to grow in the low single digits and the other in the higher single digits, something like that. Plus potential for acquisitions, which they are aiming to continue on doing I'm hoping when they get their cash situation more stable. So I think 6% is fair. And that is going to be from the normalized revenue. Am I too optimistic now? I'm wondering if I'm too optimistic about it. Which is not right now. It's not their normalized revenue. Right now, their revenue is really depressed because of the low snowfall and the chassis supply issues and all the issues they had still with the inflation and labor issues and stuff. Which they're still getting out from. So we're gonna take the normalized, okay, I'll get there in a second, and the net income margin, which I should have pasted here, their history, but it was around 10, even higher than 10% until COVID, and then it's gotten lower and lower. So I think honestly they can do more than that, but I'm going to assume only 10% because they have so much issues with margins. So again, I think they can get to 30% of gross margin, and then I think 10% of net income margin gap is like conservative, I hope. But again, they cannot get there at all, and that's gonna be gradual because right now they're far from it. I think they're around 4 or 5% right now. But those are really abnormal years. So this is my model. Let me put myself right here. So yeah, ignore those cells because I just forgot to erase them. They mean nothing. This is the historic revenues they had in the past several years. And those are the analyst expectations, which I don't usually use. But in this case, I am going to use them because I think what the analysts reflected here are normalized weather conditions, where that's what we have. We have to assume normalized weather conditions, and then we will be surprised for the better or the worse. And again, I will talk about my thinking about where weather is going in the conclusions, but and some kind of gradual normalization in the chassis supply. I hope that what the analysts are projecting, and I hope they don't think that the chassis are going to suddenly resolve themselves in 2025. I don't think so. So I am using their, which I don't usually, their estimates. And then from there, I'm going to assume 6% growth. Shares outstanding, the company did buy shares in 2022. I didn't put that here, but now of course they're not, because they don't have cash. They kind of wish they had that cash back now, I I think. But they might, they still have the share buyback program on. But I'm not going to assume they're going to use it, because at the same time, I don't think they're going to issue shares, but they're just not that kind of thinking. But I'm just, this is how they grew their share count until 2022, then I'm just assuming that. So the net margin is going to gradually improve until 10%. Like I said, this is not their current net margin, just what I think their earnings power is. So I'm just like normalizing it, and not until its full potential. So to get to the fair value even today. So this is going to be their EPS, and we can see that in my model, in my estimations, they will get to the $3 they wanted in 2025 only in 2027, which is totally okay. Maybe it would be, it just it's rough, so it could even happen in 2026. It could also happen in 2030. We don't know. Those are just estimations, or just like a range to think about. And the PE ratio. So their historic PE ratio was surprisingly high. I think it was 22, which is really high for a company that didn't manage to grow earnings. I hope the market always understood that they have the earnings power, which is just, there was always something else that was interfering. Although, again, I'm not sure what it was before COVID. I could have listened or searched for it in the transcripts. I didn't. So I'm not going to assume that the PE will get back to like 22. I'm going at its max. I'm willing to pay right now 15 times earnings. So even if we today think that we're willing to pay only 10 times because of all the headwinds and all the issues the company is dealing with, so it's going to again gradually improve to 15. So this is the fair value every year. We see that today it's around $20, so it could get even lower. It always can. But I do expect it to improve significantly. And this is the percent we're expecting to get, the return we're expecting to get from the current price to this year. And this is excluding the dividend, plus the dividend of 4 and something percent, which for me, which I'm deducted, the tax are deducted before I even get it for me. So for me, the dividend is around 3.5%, I think 3.7, I'm guessing, something like that. So it's together it's more than 20% return, which is really cool. Even if I don't look at the 19%, which is the highest, I just look at it because I like to say 3 years ahead. But even if I look at the here or here and add to that the dividend yield, also it's really a nice return. And we can see that from the current price. If we take in 7 years, which I didn't still adjust my Excel to 2024, but again, we still have a year until 2024 reports, so it's okay. In 7 years, it's gonna be $58. So if I take a discount rate of 10%, which I usually take more than that, but I think Douglas is a more stable company, an older company, and lower risk, which I'm not sure, company than usually. So I'm willing to pay less for it, and the dividends. So with the dividends, it's going to be like 13.5%, 14.5%, which is a really okay, really fine discount rate. So we get to a fair value of $30 today. and right now it's at 24.5. So we still have a margin of safety even buying from this price, and that's why I'm thinking adding more. I am thinking about it. So this is my model. If we look at discounted cash flows, I use Guru Focus for it. So this is using the EPS without non-regular items. If we take, of course, that hasn't been the EPS in the last couple of years, but as I think of it as a normalized EPS, and I do, so I use that. Again, discount rate of 10 for the same reasons. And if I project a growth of 6% and a terminal growth of 4%, so we get to a fair value of $33, and then we have an upside of $30. 30%, I'm sorry. So that's good, I guess. And if we're using free cash flow for the DCF model, it looks pretty much the same. Again, I played with that, and somehow I got to the same amount. It's in dollars, but I had different considerations when I did that. And here I incorporated a growth of 7% because I think they're supposed to make more cash when things stabilize. So there's still more improvement in the cash department, I think, because they will have more stabilized like inventory management and everything. So I think I can project a little bit higher growth here. I don't know if that's fair. Maybe I should have just taken a higher initial value, but that's okay. Never mind. That's just rough. So we see it's here. It's also undervalued. Yeah. So that got us to the end of it. So my conclusions about Douglas Dynamics are that, first of all, I do think that most of the factors are external for the company. It doesn't seem like have many internal issues. The one thing I would be worried about internally are the declining gross profit margins, which have been there even before COVID, and I'm not sure why. And I'd like to think that the management is transparent with us about it, but I'm not sure. So this is one of the biggest risks. The second risk is that it's going to take many more years than we're expecting for the chassis supply to stabilize, which for me is pretty much shocking. I don't understand. If there's so much shortage in chassis, aren't we supposed to, does it take really that long time to ramp up? I mean, I'm kind of curious. Maybe I will read more about it. So this is another risk, because if it's going to take longer, then what I didn't mention here in my valuation model is that I didn't do a pessimistic and optimistic and plausible scenario. I just did one scenario, maybe out of laziness, but also because I don't think there is this much. I mean, it's all here, and you can pretty much deduce when you look at it. I mean, unless you believe there's not going to be any more snow and there are not going to be any more chassis ever, this is pretty much the plausible scenario. And if it's going to take more time for the snow to come back, or the snow is going to gradually disappear in the pace that once projects it, then of course you can just reduce it from those fair values. And if the chassis supply issues are going to prevail longer than we think, then again you can just subtract more from those fair values. And on the other hand, if we have a surprisingly good snowy season next year, or the chassis supply will surprise us and there's suddenly going to be some like really catalytic good news about it, so it's gonna of course become better. So there's not much. It's just a scale which is pretty much even. So that's why I didn't. Of course, maybe if I wasn't lazy, I would still see how that would look in the fair values and the valuation of the company. But what I was going to say is that the biggest risks are that the chassis supply is going to take longer, and then it's going to take longer for the company to get to the $3 EPS, or it's just going to get longer for the company to get to those valuations that I projected in my model. And I think for me, the biggest, I just want to mention also the risk with the currently low cash reserves, the overextended already credit facility, and the debt that is the leverage ratio that is over. I think they're going to manage through that because there is a strength in the company, and if they need more finance, they will probably be able to get that even if it's in a more inflated interest rates. So again, I don't think the company is going to go under. It's not there. So, but again, it's a little bit uncomfortable. But I think the biggest risk for me is the risk, of course, of climate change and global warming and the situation with snow. So it is the first time that the company is seeing such low levels of snow. And are we surprised? Of course, we're not surprised by it. We're all kind of already were watching out for it. I don't know what I think about it. I have no firm opinions about it. I personally think I would never be able to get all the information truthfully as I would want it to have to make conclusions. So I'm not even trying to. But if I had to put my money on it, I need to bet on something here, because when you invest in company like Douglas, you of course bet on where climate change is going a little bit, because if you believe that snow is going to disappear in the next 5-10 years, then of course you wouldn't touch a company like Douglas Dynamics. Then again, if you believe that the whole global change is a hoax and there's going to be regular snow levels like it's always been, it's just fluctuating like it's always have been, then of course you can bet really with a free mind and sleep well at night with a company like PLOW. Douglas Dynamics. I am somewhere in between, going to the side of where I believe things will be normal. It will be, if there will be a deterioration in the amount of snow, it will be gradual. I don't think it's going to disappear in the next few years. Maybe we will see lower than average snowfalls, but it's going to be gradual, and it's not going to reflect itself every year. And it's something you would a little bit could see long term, really long term. I don't mean like long term like my investment long term of 5-7 years. I mean 20, 30, 40 years. So I think, but who knows? I'm really not a big fan of the subject, and I haven't researched that at all, honestly. So that's my bet. My bet is it's a little bit uncomfortable for me, and this is for me the thing that will make me not sleep totally okay at night with an investment like Douglas Dynamics, is the thing with the climate change, where I'm not sure about the amounts of snow and where they're going to go in the northern hemisphere in the next decade. So this is the biggest risk for me, because the chassis, even if it takes longer, it will improve. Again, I'm still scared of what will happen when it will improve, with the kind of shockwave it will send through the core industry for sure, and all the industry surrounding it, the secondary industries which use it. But I'm gonna react to it when we get there. And the margins, again, even if there is a deterioration in margins, it's not as big as we see right now because of all the headwinds. So the margins should improve, even if they don't get to the high 20s, 30% gross margins. It will improve. So yeah, for me, the biggest risk is the climate change. But again, I'm not the one that thinks that snow is going to simply disappear. So yeah, but on the other side, I do think it's a solidly managed company. They have their head straight, and they have a management that's there for many years, and there seem to be doing something right. And they have the dividend. I think it's like a stabilizer. Again, I'm not a dividend investor, but it just gives a feeling of stability. Maybe it's illusionary, but it is. I do feel it. I think that again, because I do think the chassis supply is going to improve, and I do believe snow will come back to Boston, then the upside here is big, like we saw in the valuation. I think it will get to $35, $40, $45, $50 in the next few years. So the upside is really big, and when that happens, I think the risk-reward profile here is really nice, and that's what why I think, although I have a kind of a moderate position in it, and I wish I had less so I could add more, but I think I am going to add more to it. It's going to be my first move in the portfolio for quite a while. I haven't done anything until now. I was just trying to understand where I'm standing and gaining my confidence back. So I think I will add more to it because the risk, I really like the risk-reward profile with this one. So yeah, I really ranted a lot. Thank you for your patience, whoever stayed until now, which I don't think that's anyone, honestly. But if there are, say something in the comments. So see you in the next one. Bye bye.